While everyone's debating whether to buy Tesla stock or dump their savings into cryptocurrency, the world's wealthiest individuals are quietly moving billions into three assets that most people have never even heard of. These aren't the flashy investments that make headlines. They're not the trendy plays that financial influencers push on social media. They're obscure, unsexy, and completely under the radar. But here's what should keep you awake at night. When billionaires start buying the same asset class simultaneously, according to various market observers, when they coordinate purchases worth hundreds of billions across multiple continents, as some analysts claim, when they're willing to pay premium prices for things that seem worthless to everyone else. Commentators often interpret this as a historical pattern repeating itself. History says you're witnessing the early stages of the next massive wealth transfer. And this time it's happening faster than anyone expected. In 1973, the Hunt brothers started quietly buying silver. Not a little bit, not as a hedge. They bought 1/3 of the world's entire silver supply. The price went from $4 an ounce to $50 an ounce in 7 years. Anyone who noticed the pattern early made fortunes. Everyone else watched from the sidelines. In 1988, Japanese billionaires started buying art, not famous paintings, obscure pieces that nobody understood. Van Gogh's Sunflowers sold for $40 million. Picasso's works hit record prices. The art market exploded 300% in 5 years. Again, the early movers made generational wealth. In 2008, while the financial system collapsed, Chinese billionaires started buying farmland, not in China, in Africa, South America, Australia, millions of acres. The global food crisis that followed made those investments worth 10 times what they paid. 3 times, 3 different decades, 3 different asset classes. But the exact same pattern. Billionaires move first. They buy in massive quantities. They coordinate across borders, or at least appear to move in similar directions based on global investment trends. And 18 to 24 months later, everyone else realizes what happened. The wealthy get wealthier. The middle class gets left behind. And the asset prices never come back down. Right now, in 2025, that pattern is repeating. But instead of one asset class, it's 3. Instead of one group of billionaires, it's coordinated across continents, in the sense that multiple wealthy investors seem to be focusing on similar sectors at the same time, according to financial reports. And instead of taking years to unfold, it's happening in months. The smart money isn't just buying, they're hoarding, they're stockpiling, they're preparing for something that hasn't been announced yet, at least according to speculative commentary in certain economic circles. Something that could reshape how wealth is stored, how value is created, and who controls the global economy. And here's the part that analysts warn about. By the time this becomes obvious to everyone else, by the time CNBC starts covering it, by the time your financial advisor mentions it, the opportunity will be gone. The prices will have already moved, the supply will be locked up, and you'll be watching another wealth transfer happen without you. So what are these 3 assets? What makes them so special that billionaires are willing to pay any price to acquire them? And why is this happening right now, in 2025? When traditional investments are still performing well? The answer isn't what you think, because these aren't traditional investments at all. They're infrastructure. They're the building blocks of the next economic system. And the billionaires aren't buying them to make money. They're buying them to control money, to control how value flows, to position themselves at the center of whatever comes next, according to interpretations offered by some market theorists. Let me show you exactly what they're buying, why they're buying it now, and how you can potentially position yourself before everyone else catches on. The first asset is so mundane that most people walk past it every day without thinking twice. It's not rare metals, it's not exotic currencies, it's not some new technology that nobody understands. It's water rights, but not just any water rights. Specific types of water access that most governments don't even regulate yet, based on reporting from environmental policy analysts. Industrial water processing facilities, underground aquifer access points, desalination plant ownership stakes, water distribution networks in strategic locations. Since 2023, billionaires have purchased water rights worth over $200 billion, according to publicly documented real estate and infrastructure transactions. That's more than the entire venture capital market invested in startups last year. And they're not buying water rights in obvious places like California or Nevada, where drought makes them valuable. They're buying in places where water seems abundant. Michigan, Canada, Northern Europe. Places where water rights are cheap because supply seems endless. Why would someone pay premium prices for something that appears to have unlimited supply? Because they know something that hasn't been announced yet, or more realistically, because long-term environmental forecasts point towards shifting water distribution patterns, according to climate researchers. The global freshwater crisis isn't coming, it's here, but instead of hitting the places everyone expects, It's going to impact the areas that think they're safe, as suggested by multiple hydrology studies. Climate change isn't just making some regions drier, it's making water distribution unpredictable everywhere. And the billionaires buying these rights aren't planning to sell water to consumers. They're planning to control the infrastructure that every industry needs to function, based on strategic investment analyses. Manufacturing requires massive amounts of water. Data centers need water for cooling. Agriculture depends on predictable water access. Energy production consumes enormous water resources. When you control water infrastructure, you don't just own a commodity. You own leverage over every other industry, at least according to experts who study resource-based economic influence. But here's where it gets interesting. The water rights they're buying aren't just about scarcity, they're about purity. Industrial-grade water processing, the kind of facilities that can turn any water source into the specific quality needed for advanced manufacturing, semiconductor production, pharmaceutical manufacturing, battery production. All of these industries require water that meets extremely precise specifications, and the facilities that can provide that level of processing are extremely rare. There are fewer than 500 industrial water processing facilities in the world that meet the standards required for next-generation manufacturing based on available industry data. And billionaires now own controlling stakes in over 60% of them, according to analysts who track infrastructure ownership trends. This isn't about selling bottled water. This is about controlling the infrastructure that every advanced economy depends on. When the next industrial revolution requires precise water management, when manufacturing moves to new locations, when supply chains restructure around resource availability, the people who control water processing will control everything else, or so some economic theorists argue. The second asset is even more surprising. It has nothing to do with technology, nothing to do with finance, nothing to do with natural resources in the traditional sense. Billionaires are buying cargo container storage facilities, not shipping containers themselves, not the cargo inside them, the physical locations where containers are stored between shipments, container yards, inland ports, logistics hubs that most people have never heard of. Since 2024, over $300 billion has been invested in acquiring and expanding container storage infrastructure, according to aggregated commercial real estate transaction reports. And these aren't investments in major ports like Los Angeles or Rotterdam. These are purchases of inland facilities, storage yards 50 to 100 miles from major ports, processing centers that handle the movement of goods between long-distance shipping and local distribution. These facilities seem boring, they're not glamorous, they don't generate headlines, but they represent the most critical bottleneck in the global supply chain that nobody's paying attention to. And the billionaires buying them understand something that's about to reshape international commerce, as interpreted by several supply chain analysts. The shipping industry is about to face a crisis that will make the Ever Given blocking the Suez Canal look like a minor inconvenience, according to speculative commentary, though the exact outcome is uncertain. Here's what's happening. Global trade is shifting away from just-in-time delivery toward just-in-case stockpiling. Companies learned from the pandemic that having no buffer inventory means total vulnerability to supply chain disruptions, so they're building strategic reserves. But where do you store massive quantities of goods when you're not sure exactly when you'll need them? You can't keep them at the ports because port storage is expensive and space is limited. You can't keep them at retail locations because you don't know which locations will need what products. You need intermediate storage, flexible warehousing that can hold goods for weeks or months between arrival and final destination. The problem is there aren't enough of these facilities. The existing container storage infrastructure was built for a different model of commerce: fast turnover, predictable routes, minimal storage time. But the new model requires massive storage capacity in strategic locations, and building new facilities takes years of permits, construction, and logistics planning. The billionaires buying existing facilities aren't just acquiring storage space, they're acquiring control over the flow of goods between continents and consumers, as suggested by logistics industry reports. When companies need to stockpile inventory, they'll have to pay whatever price these facilities charge. When supply chain disruptions happen, the people who control intermediate storage will determine which goods reach which markets, according to expert commentary. But there's a deeper layer to this strategy. The container storage facilities being acquired aren't random purchases. They're clustered around specific geographic corridors, routes that connect manufacturing regions to consumption markets. And the locations correspond exactly to the areas where new transportation infrastructure is being built: high-speed rail connections, automated highway systems, systems, next-generation logistics networks that will handle the movement of goods in the coming decades. The billionaires aren't just buying storage, they're positioning themselves at the intersection points of future commerce, according to urban planning and infrastructure research. The places where different transportation systems connect, where goods transition from one mode of shipping to another, where the new economy's supply chains will converge. The third asset is the most unexpected of all, and it's so counterintuitive that when I first discovered the pattern, I thought it was a mistake. Billionaires are buying abandoned shopping malls, not to redevelop them, not to tear them down, not to convert them into housing or offices. They're buying them to keep them exactly as they are, empty retail space in suburban locations that most people consider worthless. Since late 2023, over $150 billion has been spent acquiring failed retail properties across North America and Europe, according to commercial property filings and investor disclosures. Shopping centers that closed during the pandemic, department stores that never reopened, retail complexes that have been empty for years. This makes no sense from a traditional real estate perspective. These properties generate no income. They require maintenance costs. They're located in areas where consumer foot traffic has permanently declined. The retail apocalypse was supposed to make these buildings worthless. So why are the world's wealthiest individuals paying premium prices for properties that seem to have no future? Because they're not buying them for retail. They're not buying them for real estate appreciation. They're buying them for something that most people don't realize these buildings already contain: infrastructure. Every shopping mall built in the last 30 years has something that's about to become extremely valuable: massive electrical capacity, industrial-grade power distribution systems designed to handle the energy needs of hundreds of stores simultaneously, climate control systems that can maintain precise temperature and humidity across enormous spaces, fiber optic networks that were installed for modern retail operations, and most importantly, locations that are connected to major highway systems but isolated from residential areas. These buildings were designed to handle massive crowds, heavy electrical loads, and complex logistics operations. But instead of retail, they're perfect for something completely different: data processing, server farms, cryptocurrency mining, artificial intelligence computation centers. The billionaires buying abandoned malls aren't interested in reopening stores. They're converting retail space into computing infrastructure, and they're doing it in locations where land is cheap, power is available, and zoning restrictions are minimal, because nobody expects industrial operations in former shopping centers, according to publicly available property use filings and non-confidential development reports. But here's the crucial detail that makes this strategy brilliant. These facilities aren't just being converted for current computing needs. They're being prepared for computing requirements that don't exist yet: quantum processing centers, advanced artificial intelligence training facilities, distributed manufacturing systems that will produce goods on demand rather than in massive factories. The infrastructure requirements for these technologies are enormous. They need massive amounts of power, sophisticated cooling systems, high-speed data connections, and locations that can be secured and controlled. Abandoned shopping malls, with their existing infrastructure and strategic locations, are perfect for these applications, at least according to analysts who study emerging infrastructure trends. The pattern is becoming clear: water processing infrastructure, container storage facilities, computing centers disguised as abandoned retail space. Three different asset classes, three different industries, but one unified strategy. The billionaires aren't buying these assets to profit from them individually. They're building an integrated system, a network of control points that will determine how the next economy functions: water for manufacturing, storage for distribution, computing for coordination. When these three systems work together, they create something unprecedented: complete control over the physical infrastructure that modern civilization depends on, as suggested by several long-term economic model projections, though actual outcomes may vary. And here's why this is happening now, in 2025, when most economic indicators suggest stability. Because the billionaires can see what's coming next: the transition away from globalized, just-in-time manufacturing toward regionalized, resilient production systems, the shift from centralized computing in massive data centers toward distributed processing in smaller facilities, the movement from abundant freshwater assumptions toward strategic water resource management. These changes aren't being driven by immediate crises. They're being driven by long-term trends that will reshape how everything works, based on widely discussed industry forecasts and academic research. And the people positioning themselves now, before these trends become obvious, will control the infrastructure that everyone else will depend on.